Thank you so much. Can everyone hear all right? There's quite a lot of background noise out there. Well, thank you for that introduction. And I think it's very easy to become despondent with the scope and scale of the challenges that we have. But I think the panelists that we've brought together today will give you some reasons for optimism, actually, and that actually taking some of this into our own hands and doing something about the challenges that we have actually makes a difference. Quick introduction from myself. I'm CEO of British Patient Capital. British Patient Capital is a commercial subsidiary of the British Business Bank. We're here to invest in some of the most exciting technology companies in the UK to help them on their journey. And we have the transition to net zero as a central part of the mission that we have at the bank. In terms of where British Patient Capital can play, we invest through the market, so we select leading fund managers that are aligned with our mission and strategy, and they go on to invest in some of these groundbreaking technologies, and we'll hear some more about that today. The transition to net zero is not just about high technology, it's about lots of other actions that we can take to get us into a better place in terms of carbon reduction, and we'll be addressing that on the panel as well, especially with one of our panelists here. I'm going to hand over to them to introduce themselves, briefly themselves, and then I'll kick off with some questions. And then I would like to invite some questions from the audience as we get towards the end of our session. But first of all, can I just hand over to each of our panelists to introduce themselves? Ladies first.
Hi, everyone. I'm Estia Ryan from Eka Ventures, and we are an early-stage impact fund investing in UK companies. When I say early stage, these are roughly 1 to 2 years old, so at the forefront of technological innovation. We don't only invest in climate, we also invest in health and have a particular interest in the intersection between the two. To date, we've made 15 investments across a range of companies, ranging from more sustainable packaging, circular shoes, and reverse logistics. So really excited to be here, and thanks for having me.
Thank you. Patrick.
Hi, I'm Patrick Sheehan. I run a venture capital fund called ETF Partners, which stands for the Environmental Technologies Fund. So we invest a little bit further down the track, typically £5 million plus. When you're beginning to do a really great job, when you really want to go for it, that's the time to talk to us. We've been doing this since 2006. I was in venture capital many years before, but my colleague Rob and I, really believed in climate change back then, and we thought we just needed to do something about it. So we've been on a mission for a long time, and hopefully now we're at the beginnings of something great with you.
Thank you. Scott.
Morning, everybody. My name's Scott Marshall. I'm the founder and managing director of Roma Finance. We're a non-bank lender. We started lending in 2010, and since we started in business, we've lent just under £500 million on 2,500 transactions. And our mission is to help solve the UK housing crisis. And more recently, we've seen that more and more of the projects that we've been funding, our customers are building eco-friendly properties.
Thank you. So let's kick off with some questions for our panelists today. We know that the transition is often considered as a sort of capital-intensive one. So I'd like to start with talking about the sources of funding that you have for your operations, and I suppose how easy or challenging is it for you to raise the capital that you need to execute the strategies that you have for your respective businesses? May I start with you again on that challenge of finding LPs and finding sufficient LPs to fund your ambitious plans as well?
I think we've been really lucky at Eka Ventures to have most of our LPs being impact dedicated, which means we get a lot of help actually, rolling out our own impact strategy, which has been exciting. I guess one stat that I think of when thinking about, the capital dedicated to impact, it's grown 10x in the past 10 years. So putting that in numbers, that's $1 trillion of impact capital across venture, private equity, and public markets. That's a big number, but we still have a lot of room to grow. That's 1% of global AUM. So while there's a lot of capital availability, I still think we can have more dedicated funding as well to venture specifically.
Thank you. Patrick?
So our funding is largely from institutions, from British Patient Capital and other similar organisations. Thank you very much. The majority of it comes from insurance companies and pension funds, and they are driven by making money and return, as are we. And the trick is that that is congruent with very big impact, right? So that's alignment of interest is the whole secret of success in our business, in fact.
Yeah, I'll make no secret of the fact that when I started the business 13 years ago, it was nigh on impossible to get funding to help us get off the ground. And in fact, I took equity out of my own house to get the business off the ground. Fast forward 13 years, and with the track record that we've got, we've now got funding lines from a syndicate of banks, building societies, VC debt funds, the British Business Bank, and also we're about to complete a transaction this week where one of the local combined authorities is lending into our business to help us grow and help solve the housing problem in the northwest of England.
So is it fair to say that it's getting better?
Yeah, as we've built a track record, so we found it easier to raise money.
So it's about the maturity of your track record and business concept. I'd like to move now down a level to the opportunities that you're looking to fund and support, and perhaps tell the audience why that's going to make a difference, I suppose, in terms of the theme for today. Scott, should we start with you?
Yeah, it's really interesting how things have evolved, particularly over the past few years. We're seeing more and more local authorities, when they're issuing planning consents, require that the developer, that one of the conditions, or a number of the conditions of the planning consents, that the developer installs in the properties, whether it's EV chargers, better insulation, better soundproofing, a better EPC, whatever it is. We found that actually local planning authorities are helping the cause by insisting on green ideas and green initiatives within the properties that get built.
Patrick?
So we focus on companies that are up and running with revenue and beginning to look at very rapid expansion, or indeed are already expanding very rapidly, and typically addressing exciting and large markets. We've been doing this for many years, and over those years have honed into an area where I think venture capital can be most effective, which is what I would call the intelligence layer on top of infrastructure. And part of the reason for that is we can roll out things very fast and therefore have an impact very fast. We tend not to do big engineering projects that might take 20 years to come to fruition. You know, climate change is urgent now, and we really want to see impact today. So when we talk to people, we're very concerned about the impact they're going to have as well as the profit they're going to have.
Thank you. Estia?
So it's hard to pick one area that I'm excited about. I think just being in this conference center, you see so many exciting theses and ideas. If I have to pick one where we've most recently made an investment, it'd be the home decarbonization space. So we've made an investment in a really early company that's looking to shift your energy demand from peak times to non-peak times. And over the course of the year, that translates to saving consumers like £300 in their energy bills, which is super exciting. So you have that cost saving, but then you also have the fact that 30% of the UK's energy or greenhouse gas emissions is from residential energy use. So kind of like what Patrick's saying, we're trying to do both the impact and the financial return for shareholders, but also consumers as well.
Thank you. So let's go down to that next level, because I'm sure there'll be entrepreneurs and business owners in the room. So if somebody wants to raise capital from you, what sort of propositions would resonate? Maybe Patrick, let's start.
There'd be propositions that we find exciting, which is in a very human terms. When we invest in companies, we're engaged, we're on the board, we're working with the founders and the entrepreneurs, and so frankly we need to get on and believe that there's something big and worthwhile happening. So the human level we would emphasize to a very high degree, but actually then we need to see there's going to be a scale of impact and a scale of value creation which is going to make a difference. And that's always a challenge, right? Because by definition, we're doing new things. And so we will take risks, we will take some things on trust, but we need to understand there's ambition coupled with realism, and a willingness to grow a business as well as just be the entrepreneur.
Estia.
Yeah, so totally agree on the founder alignment point. We spend a lot of time with founders making sure that you're in it for the impact motivation as well as, the financial motivation. That's number one. The second one I'd flag is measurability. So the same way that with a lot of venture firms, you'll pitch and say, we're at 1 million ARR, we're at 1 million revenue. Like, you should also come into the pitch saying, we're delivering this amount of impact, or we think we can achieve this amount of carbon reduction. So early data points on the unit economics of your impact, I think, is like really, really important.
Okay, so slightly different answer from me, obviously. What we're looking to fund are small SME house builders that the banks are not able to support, that are creating a product that's in or near an urban area, near schools, hospitals, universities, on major transport routes, where we know that the end product is going to meet a local demand and the market's going to be liquid.
Okay, great. The last question before we open it up. What do you think are the biggest challenges or perhaps opportunities that you have in your business, looking into the next year to 18 months? Let's keep it very focused to near term.
So these days, we feel we're surrounded by opportunity, and that's great for us. It's a challenge for the entrepreneurs, actually, because we're seeing over 1,000 companies a year, a number of whom will get funded. We want to invest in a small handful, right? So actually, I think it's about being selective for us, and if you're talking to us, recognizing that we will be selective, and so making things utterly compelling. And compelling isn't easy, so I think actually finding ways to hone what you're saying, to chat with others, to rehearse, to understand the weaknesses in your own arguments before you come to us is worthwhile. We try to be approachable, but we just get very busy, right? And so if you can talk to advisors, the sort of advisors who really give good advice, not necessarily just professional advisors, and find people who know us to work through our network, that's really helpful.
Yeah. I mean, just to build on that, the British Business Bank has a finance hub, which is a website which has a lot of content, which is designed for entrepreneurs to help them find where they can go next for their funding, or what they would, some content that would help get them investor ready, to your point, Patrick. So that might be something that you would be interested to look into, Exia.
Yeah, the way I'll answer that is slightly higher level. So we all respectively play a very small part in the entire transition, and I think there's kind of a rising tide lifts all boats. Like, we need to get regulation on board, we need to get consumer demand on board, we need to get talent moving into the right sectors. There's been loads of layoffs. Why not come to impact? We need to get more investors involved. So I think harmonizing all of that good intent into action is kind of why we're all here today. But that's what I'm excited but also scared about.
So we see some challenges on a national level, on a local level, and also in an industry level as well. So if I deal with each one of those, on a national level, we are seeing certain issues, for example, around nutrient neutrality, which are preventing house building in areas where houses and new properties are required. That's number one. I think that issue has been around for the past 2 years, and it started around the Solent area and has spread to much of the south and east of England. Hopefully, we're nearing a resolution on that problem. On a local level, we've seen that there's been material delays in local planning authorities granting consents for new schemes, and then within an industry level, we've seen that the surveyors and valuers are yet to really appreciate and understand that the end product, which is more energy efficient, actually commands a higher value in the market when it's completed. Okay, and actually that's a real mind shift change that's got to happen in order that our customers can go and put the investment into the schemes in the first place, where they know that they're going to get the value at the end, because effectively everything is all tied in together.
It's a really important point, and I think that's the transition that we've seen with the institutional community in very recent times, that you can have impact and actually it's financially beneficial as well. What we want to do, of course, is to create both, but it doesn't have to be one or the other, which is probably where the thinking was maybe 10, 15 years ago. Well, let's open it up to the audience here if anyone has a question. Do we have a mic? We don't have a mic? Come up here and ask us. And I can repeat the question then if you like, yeah.
My name is Paul Camp.
Yeah.
I created the world's first green bond under the climate bonds.
Ah, right.
We have a new panelist.
Asking Scott Marshall, cost of capital now with respect to the increasing interest rates and how that's impacting
Right.
the way that he structures his debt, and whether or not, second part of the question is, as he looked at crowdfunding, I raised 50 million from crowdfunding via green bonds.
Right. I don't know if did you hear that? No. Okay. Brilliant. It's quite technical, so I'm pleased the mic has come.
Hello?
Is it at the bottom?
I won't say. My name is Paul Camp. I have a background in finance. I created the world's first green bond under the Climate Bonds Initiative, and now there's $250 billion that have been certified. I've got a question for Scott Marshall, please. In terms of cost of capital, you're saying you were doing debt. Now, we've all seen short-term interest rates rise, and I just wondered how that's impacting things for you. And second part of my question is, I raised 50 million from the UK public, from people like you, to go out and develop and build solar farms so that you could get returns on your solar. And then the returns on your solar, because it was so high, would then offset your energy costs in your energy bill. I just wondered, what you're looking at doing in terms of structuring your financing, whether because you're doing, you've got people buying houses and you've got the public, whether you're looking towards maybe doing something like that, because then you're disintermediating the banks. You're going to a lower cost of capital, and you're also benefiting the public who benefit from the returns, subject to risk, and then also you're getting it done much quicker. Thank you.
Okay.
Thank you.
I think maybe I should have got a pen and paper to write all the different questions down there. Let me just deal with the first one first, which is, at my age, the only one I can remember, which is that you're absolutely right, Paul, that the cost of capital has gone up. Okay, no doubt about it. But what's also, and also the cost of materials has gone up and the cost of labour has gone up. And over the past few months in particular, we've seen house prices stagnate. Okay, so effectively you've got rising costs against a flat GDV, which means that a developer's margin is under pressure. Okay? What you tend to find is that while all those things are true, the most volatile value is the land at the beginning or the unconverted commercial property into resi, okay? And developing is all about maintaining margin. And at times of economic stress leads to volatility, volatility leads to opportunity, volatility leads to better buying opportunities that our customers can take advantage of, okay? And so if developing is all around maintaining margin and a customer can buy better, and in particular, we're starting to see that a number of schemes are, things are slowing down on a house building front. That means the availability of labour increases, the cost of labour comes down, material suppliers are overstocked, they're doing discounts to offload stock. So all of a sudden, natural market, it starts to correct itself. And even if the GDVs do come off a little bit, actually developing is all around maintaining a margin. And the capital market will always be healthy in that way.
Thank you, Scott. I think Patrick wants to come in.
Yeah,
on
I was going to
this as well.
generalise your question, actually, if I may,
Yes.
because we've been in a remarkable era of capital abundance for several years, and in venture capital that's just been weird, right? There's been huge amounts of money sloshing around, often not wisely, and entrepreneurs occasionally have felt that success was raising money rather than delivering great businesses. That era is dead, right? And we're very focused now on, thankfully, on creating real businesses that can get to cash positive, that can make a real difference in the world with constrained amounts of money. Sometimes very large amounts, but but that era of capital abundance is frankly over, and I think we'll all be better for it.
Yeah. I think we have time for one more question. Is that right? Do you want to come up front? It's
Sure. No, it's coming on now. Yeah, Simon Holland from Barefoot Lightning. We work globally in the livestock sector, and a big issue there obviously is in the cattle sector is the burping methane. Because, 70-80% of the cattle population is in these global south countries. We've built a team in some of these countries to do that. But now we've looked a few times at British Business Bank funding, and it seems to be tied to we have to have 100% employees, UK employees. I don't know if I'm being misled or misunderstanding that, or...
yeah.
So I had two questions. First, have I misunderstood? Second, do you guys have finance to get around that, if that is the case?
Yeah. So there's not a very straightforward answer to that question, because all of the programs that we manage come with different criteria. But for all of our programs, there is a strong UK component because, of course, we're investing taxpayers' money here. So we want to make sure that that's feeding through into economic impact in the UK economy. Also on agriculture, traditionally, that hasn't been an area that we've covered. But we're just starting to look at that now, being in, let's say, a new regime. And British Business Investments has supported a non-bank funder that looks at the agricultural sector. So I'd encourage you to have a look at British Business Investments. It's a commercial subsidiary of the British Business Bank, and they're probably, most ripe to have that conversation. One or two more questions. Wonderful. Do we have... You have a question. Okay.
Yes. Yes, I have a question. The majority of impact investors, from my experience, they're sort of shy away from dirty industries. They don't want to dive into decarbonizing oil refineries, for example, or because they want their investment targets to be clean and clear, from this, I don't know, GHG capture, for example, or something like this. But at the same time, when we realize that the fossil fuels still produce, 90% of the global energy or more, and things are not going to change very quickly, despite our efforts. So decarbonizing these dirty industries or, I don't know, metal production or something like this, could bring more significant change. At the same time, impact investors are not very eager doing this. What do you think? Am I correct?
Shall I just come in a little bit on that debate? And I'm going to take it a little bit broader than that question. But I said at the beginning, solving the climate crisis is not just about working with fast-growing technology companies that have solutions. There's a whole SME community that we have to face into and bring with us. So I think in the way, and Julia is the expert on this, but we're looking to support all types of SMEs that will put themselves on a path to reduce their emissions. And we think that's an important part of the story, as well as, what technology solutions do we have to get to where we need to be more quickly. So I absolutely understand the direction of the question. Patrick, did you want to come in?
Yeah, this is a wonderful opportunity to rant for a minute. And so I must take it, right? Because clearly the world needs to transition, and so old-fashioned industries need to transition and be less dirty. But that's often just an excuse, and I think we need to get a bit more assertive about the need for real change with some of those industries. We do need to just stop oil at some stage, right? Rather than just allow it to meander towards some sort of fudge. And so I think actually all of us need to step up to the plate. Our focus isn't on heavy industry, it's on technology, but we do find the use of technology in some quite old-fashioned industries. We have an investment in an AI software company that makes shipping probably 10 to 12% more fuel efficient. And that's a small amount of capital to create that company, but shipping is 3% of global emissions, so 10% of that, 0.3% of the world's problem is addressed by a small equity investment. So actually, even with technology, we can have big impact on some of these old-fashioned industries.
Yeah. If I can also come in on that. So I think the way that we like to think about it is like there's a Venn diagram of all the climate change issues that need to be solved. And then there's another circle of like where venture capital can play a part. And actually the intersection of the two is relatively unique. That's not to say you shouldn't decarbonize oil, but you need to be really smart about the way you deploy scalable technology in a venture setting. One investment we've done in decarbonizing steel, which again is 10% of greenhouse gas emissions, is a software that plugs into existing steel plants and better optimizes the heat generation. So instead of overheating or underheating your steel, you're better managing that flow over time. And again, going back to that point of saving money, you're saving money because you don't have to pay as high energy costs, but you're also saving carbon emissions because you're not overheating and underheating. So that's an example of where technology helps in that deep industry context, but is still a venture-style investment.
Mm-hmm.
So,
Scott,
yeah, let me just give a slightly different perspective, which is that obviously in the UK we've got an awful lot of old buildings that are not energy efficient, and there's a big drive at the moment, and I think this maybe come from government or whatever, that actually air source heat pumps are the solution to those older buildings, and actually the opposite is true. Air source heat pumps will make those buildings far more inefficient and more expensive to run. So actually the solution to those buildings is either insulate them better, number one, or number two, and actually there is a pilot that's taking place in a village in Cheshire at the moment where existing gas boilers are being retrofitted to be able to take hydrogen along with gas in order to reduce the cost of running those older buildings, and the output from hydrogen obviously is water. Okay, so we can produce it ourselves in this country. We're not relying on overseas countries. There's a simple adaptation that can be given to an existing gas boiler, and we can make those older properties. We might not be able to reduce all the waste energy that comes from them, but we can certainly make them more eco-friendly to run, and we can make them cheaper, and we can be less reliant on third-party countries for the energy that's required to heat them.
Perfect, thank you. And I think heat pumps will have its place as well, perhaps in new build.
Yeah, for new build, where the insulation is already good on the buildings.
Exactly. So I've been asked to bring this. One more question. I'm having different one more question. Okay, this gentleman here. Come up to the front, please.
Hello. Hi.
Hello.
Hi, Estia. As an investor in the space, I can totally see that small place where venture meets climate. And it's a real shame because there's so much potential, there's going to be so much returns. And a lot of interesting conversations I'm having is about how can we bring alternatives funds of capital at the point of scale. So in the US, we have the IRA, in Europe, we have the Green Deal. But in the UK, we have similarly, but it's not easy to access all these grants. So my question is, what sort of alternative financings you're seeing being accessed, and how easy is it to access this capital?
That's a really good question, and the one that we spend a lot of time working with our portfolio companies on. It's true that once you have venture funding, I think a lot more pots of money open up. So that's particularly the Innovate UK grants, for example. I think there needs to be more innovation, to be very candid, around types of venture capital. So for example, patient capital, longer fund life cycles, access to debt funding. So impact debt is coming up to the fore, and that's something that we potentially didn't have back in Climate Tech 1.0. So that's an innovation. But on the whole, I think I agree with you that it's still tricky to get there, but the signs are pointing in the right directions.
And just to build on that, and probably to close this session, there's a lot of debate at the moment in the UK as to how we can persuade our domestic pension plans and asset managers to do more in this space. And I think that's part of the solution as well, because if you can bring in more capital at the top of the stack, that will filter through to funds and then eventually to more opportunities that are definitely out there. We have a demand and supply imbalance, a radical imbalance, I would say, at this point in time. I'd like to thank all of our panelists for your insights and contributions. Thank you also to everyone who's joined us early this morning for this debate. I hope you enjoy the rest of your day here. And I would summarize the whole discussion that we've been having by repeating something actually that's already been said by Estia, which is what we need to do is to harness intent and turn it into action. And I think that's what all our panelists, and it's what the British Business Bank is about as well. So thank you, everyone. Enjoy the event.